in particular the cybersecurity special interest group, I wanted to thank everyone for attending today's webinar. This is on insurance coverage for cyber risk and reality. The reality part, I think, is going to be the more interesting part of this. We are very fortunate to have Roberta Anderson Sutton with us. Roberta is a world-renowned expert on cyber risk, and I believe that she is probably the person most perfectly adequate for presenting this topic. She has had years and years of helping different level customers on a worldwide basis help understand what is cyber insurance, how do you determine how much you need, where should you get it, how do you compare the entire fruit salad that's out there. And I really don't want to steal much more of her time. Roberta, thank you very much for being here with us. I here kindly turn the microphone over to you.
Thank you so much, Dan. Thank you for having me and for that lovely, gracious introduction. I really do appreciate the opportunity to be here. So we'll start with the reality of the threat landscape. As this audience well knows, the threats are coming at companies both from a cybersecurity and a data privacy perspective from so many angles. For purposes of the insurance today, and by the way, there's insurance, we'll talk about this a little bit later, for just about every cybersecurity and data privacy related risk. There is specialized, particularized insurance available to cover it, with the one exception of intellectual property rights, the company's crown jewels that may be subject to advanced persistent threat are subject to, and the theft of the secret formulas. That sort of thing is extraordinarily difficult to price and therefore to underwrite. Everything else, there is insurance. And then the challenge lies in identifying the threat, the best insurance, and negotiating with the insurance carrier. The tricky issues are social engineering, incredibly prevalent, and vendors, and human error. And in most cases, you find a confluence of these threats that lead to an organization having a problem. And that's exactly what happened in connection with the Target breach. You can have the best computer security and the best internal privacy regulations, privacy policies, but you always have the human error. You've got Dave in the other corner. We all have him. I think the latest studies show that as well as you train employees, you're never going to get better than 90% of them not clicking on the tempting phishing emails, which leaves 10% that are clicking on them. And this is exactly what happened in connection with Target's famous huge data breach. It was, and actually the HVAC vendor of Target, which got the threat into the network and resulted in the data breach. Little HVAC company not far from where I live in Pittsburgh, Pennsylvania, at least live most of the time. It was a phishing email that tricked an employee of that vendor to click on an email. We've got, in the United States, we have laws and regulations. Worldwide, we have laws and regulations, and they're increasingly strict. This absolutely has the eyes and ears and attention of worldwide regulators. We now have the European Data Protection Act with a rather draconian penalty of 4% of annual turnover or $10 million, whichever is greater in the event of a breach of that regulation. Some jurisdictions, including a number of the states in the United States, do not allow for the insurability of punitive damages. So that also is an insurance issue. There's ways that we can address it, at least to the extent that we can practically do the best job that we can. Even U.S. companies with no foreign operations are complying with GDPR. So worldwide regulations are increasingly stringent, and often companies want to comply with the most stringent one as a floor, recognize that they're increasingly proliferating and increasingly strict. In the United States, the 2011 Cybersecurity Risk Factor Disclosure Guidance indicates the company should reveal in their public filings a description of relevant insurance coverage. So insurance is rather a big deal, certainly not just in the United States. When the SEC approaches companies with questions around their disclosures, they're now asking not just does the company have cybersecurity insurance, but how good is it? This is an insurance coverage litigator, which I've been doing for 22 years now. I find somewhat amusing. Every insurance company has limitations. So asking a company what coverage, what their insurance has in terms of significant limitations is a little bit funny, but in any event, it is a big deal. So let's talk about what is cyber insurance and what does it and what does it not cover. As far as the third-party coverages, which is the coverage that you have when you're facing a lawsuit, a claim arising out of a cybersecurity or a data privacy-related incident. There's privacy and network security, and these coverages that I'm going to talk about at first, there's about 6 coverages that are offered in some form by all 50 or so of the leading property and casualty insurers worldwide. The coverage that's been around the longest is the privacy and network security coverage. And this is what would respond to if you're a Target and you're facing a very large data breach, or a Home Depot and you're now facing 1 to 80 or 100 class action lawsuits against you. It covers against third-party liability arising out of data breaches or other failures to protect confidential information, as well as security threats to network. An allegation, for example, that your network was used to effectuate an attack on another third-party network. The questions to ask as far as this coverage goes, and although we will talk about this more later, although these coverages that I'm talking about are most immediately here are offered by many, many insurance carriers and are often termed exactly the same thing, they vary quite dramatically in terms of what exactly they cover when you really drill down into the terms and conditions of the insurance policies. So what we look for is, you absolutely, thinking of bearing in mind the target breach, you definitely want to have coverage for the acts, errors, and omissions of third parties, including vendors, cloud service providers. And without trying to throw the needle too fine here, you also want data to be covered in whoever's care, custody, or control that it is.
So Roberta, that brings up a very interesting issue in regards to cloud providers.
Yes.
How do you figure out where the data is to properly protect it?
A lot of companies don't really know where their data is when it's in the cloud because of cloud bursting and different aspects around that. You may not know. Now, when underwriting the coverage, the underwriters, the insurance carriers, underwriters are likely to ask who are your major cloud providers. From an underwriting perspective, the insurance industry has a better grasp on this aspect of the coverage, which has been around for the longest amount of time, nearly 20 years. So, but absolutely, there are many organizations that they truly don't know where their data is. And so I'm going to show an actual example of good, broad insurance policy language that responds to that point, because it covers data wherever it is, and truly at the end of the day, the company doesn't need to know, which is the best position to be in. Of course, the best position to be in is to know where your data is, but the reality is the fact that many organizations don't.
Well, the best position is never to need the cyber insurance, but that's utopia.
Yes, exactly. You get insurance because bad things happen, and it covers negligence and other things that aren't deliberate, and not knowing where your data is simply a fact of reality, really. It may not even be negligence, but no, it's an excellent question. You want the coverage to be broad enough to cover, you don't want it to just list a few privacy laws limited to Europe or the United States or any jurisdiction you're in. You want it to be broad enough language that it covers the proliferation and expansion of data privacy laws and regulation worldwide. This coverage is always written on a worldwide basis, which is good, but you definitely want those laws and regulations to be covered as they come into effect. Coverage for data in any form, paper records. If you're in the healthcare industry, that is still a huge form of data breach, liability. I had a client that unfortunately their records weren't shredded properly, huge client in the healthcare sector, and there was a hurricane and these records were blown out of dumpsters all over the city. And so those kinds of things really do happen. You want the coverage not just to cover individuals, but confidential corporate data, third-party secrets that you may have in connection with deals or otherwise that's in your control. That's a source of liability. Rogue employees. And Dan, you and I were talking the other day about how important it is to curtail the exclusions and other conditions in these policies so that they expand and cover the acts, deliberate or negligent acts of employees, which is so often
it sounds like this is just a cyber issue. It needs to be part of an insurance strategy and framework.
Absolutely. Yes, absolutely. Coverage for wrongful collection of data. And this is in the United States, you've got the Telephone Communication Protection Act as well, reaching out to people. The better policies will not just cover you for data breach, like the target breach where credit card or other sensitive data, protected data is taken, but will also cover you for breaches of the company's privacy policies, such as being able to access your data or not having your data collected and used by the company. And often, by the way, the better coverages do not cost more than the less good coverages, which makes it even more confusing for companies trying to sort through what is the best. You can't go by the cost of the insurance necessarily, but, and we'll talk about this a little bit later, the fact that these policies are all different creates a very unique, I guess it's an opportunity wrapped in challenge wrapped in opportunity, but it's a great opportunity to negotiate terms for no additional premium, which is important. So you want to have a really good team in place. You definitely want a good broker who is, preferably has worked with the insurance carrier underwriters and is respected, knows what they're talking about. I would also argue, not trying to self-promote, having outside counsel involved is very useful as well. And we have the claims experience as well. We see what insurers are denying coverage for, and you can address that proactively during the underwriting as well. But a team approach in this space is very, very important. Regulatory liability, slightly separate from the data breach privacy coverage. It's usually written on a separate basis, not always, but this covers fines, penalties to the extent insurable by law is what you want the policy to say. Funds that are required to be deposited in consumer redress funds, and you want to make sure that the exclusions in the policies have sufficient curtailment so that they don't swallow up the coverage. You also really want to pay attention in this space to the sublimits. You can have a $10 million primary policy limit that has certain sublimits applicable to various aspects of the coverage. And regulatory liability is one of the aspects of the coverage that is often sublimited. But it can be one of the most expensive it can be one of the most expensive risks from the organization standpoint. So you want to make sure that the sublimits are removed or are commercially adequate. In the United States, you've got the payment card industry data security standards liability to contend with. In whatever jurisdiction you're in, you definitely want to make sure that the policy is responding adequately to the reality of risk faced by the company or the organization. Media liability is covered offered under just about all of these policies as well. It's not really a cyber or privacy related coverage, but the media related coverage can be very valuable under these policies because where you would usually find the media coverage, unless you're a media organization and you have a standalone program for the media liability aspect, is in the commercial general liability policies of the company. But those policies over time have seen a real diminishing of the media coverage. So the cyber policy is actually a cost-effective way to get usually a broader media-related coverage. And again, we want to make sure that rogue employees are covered under the policy. We want to make sure that it's not limited to just the insurer's website, the insurer's website, or just online materials. And it's not, the last question there, is it appropriate for media companies? If you're a media company, you really do want a standalone policy. But otherwise, it's worth considering for sure. The first party crisis management aspect of the coverage is very important. If you have a data breach of any consequence, you are facing having to possibly notify all of the potentially impacted parties. The notification can be very expensive. You also have forensics investigations, public relations professionals to help you mitigate the tarnishment to brand and reputation. You want an attorney to advise who, when, how to notify the individuals who are impacted, and in a way that, again, mitigates the risk of reputation harm to the business. The questions to ask are, including, is the coverage triggered by a failure of security? You don't just want the coverage to kick in if you know there's a data breach, because you have to find out what happened first, and you want the mandiant or whoever your selected partner is to come in and help you figure out, was there really a data breach? What happened? A lot of times what seems like what happened, you receive a ransomware demand. Is it just that your files have been locked, or is this a ruse for something more nefarious? Are the thieves now taking data and they're going to publish it, use it?
Roberta, that brings up a very interesting question. When we're dealing with most incidents in insurance, particularly car insurance, you've had an accident. Where should the insurance kick in here? At the incident response plan?
Absolutely. Well, absolutely. So, couple different points about that. And one is this is a very important point. If you are an organization that's placing this coverage for the first time, so we're all working on a placement and we're going to place it August 31st. If you don't ask for what is called a retroactive date, the coverage will come into effect on August 31st, and it won't apply to things that happened before August 31st, even though, and that's particularly important in this context because, as we all know, a breach happens sometimes months, sometimes over a year or years before an organization appreciates that it happened. This was the case.
According to Verizon, 270 days is the average between a breach and identification. So yeah, very valid.
So you must get a retroactive date. All the insurers will offer this, but not voluntary. You've got to ask for it. But that is so important. Now you're covered for when you discover something that happened months ago. So that's a really important point. And then as far as even before something happens, under the majority of these policies, when you place them, the insurance carrier will offer services, X number of hours, access to counsel, breach coach counsel, tabletop exercises, reading materials, online webinars, information that really helps companies, particularly smaller and mid-sized companies that don't have the budget necessarily to engage in all of these things that they would like to do to up their cybersecurity and data privacy. So you can take advantage of those. They come at no additional cost under the policies. And then as far as when the actual insurance should kick in, it should really kick in immediately when you think that something happened, before knowing there's a breach, because there may have been no breach, but there may be an incident, and forensics can rack up, as we know. The costs can be rather they can be huge costs associated with that. Even if there's no, at the end of the day, the forensics determines that there's been no actual data breach. So you definitely want the forensics costs to be covered right away as soon as somebody figures out that something may have happened, to get the mandiant in there. You want coverage for your own forensic investigator, as well as whatever the law may require in terms of a quote independent investigator. Public relations, crisis management, breach coach counsel, call center services, all kinds of things that you need to do. And then the policies, the better ones, do cover this aspect of the coverage very well, and can really help a company get its arms around what's happened and mitigate the situation before it becomes a larger problem. On the first party end as well, network interruption is really important. When companies focus on the potential lawsuits and claims arising out of a data breach like the Target or the Home Depot or so many others, they may be missing a much greater exposure stemming from the interruption of their business and what that does to their bottom line. So network interruption is very important. This can cover and should cover not just a circumstance where the company's systems go down and that takes it offline to do business or impacts its bottom line for some period of time, but also when third-party systems go down. So a cloud provider, for example, this should cover ideally failures of the cloud. If your website is hosted by a third party, should respond to that. And that's what we call contingent or dependent business income loss coverage. That's when a third party's problem with its system impacts the insured's bottom line.
So you're covering my idiots and other people's idiots.
Yes, indeed. Yes, indeed. Now, from an underwriting perspective, this does present challenges to the insurance carriers. They often want to sublimit the third-party coverage, but there's different ways of addressing that. We can usually increase the sublimit, often for no additional increase in premium. This is really a unique type of coverage where if you ask, you can get so much better coverage in terms of substantive terms of coverage and in terms of the amount of coverage for really no additional premium. It's really quite unique. Directors and officers liability insurance, second to this. This is really very unique opportunity. It should also cover non-malicious acts, because it's not just obviously hackers that cause a problem. And so in the United States, the New York Stock Exchange went down a few years ago, and the large financial institutions that were covered with the better policies would have been covered for that incident, even though it was just a systems glitch. And even though there's no contractual relationship between the large financial institutions and the New York Stock Exchange, but that was a non-malicious event affecting a third party, but could have caused a great deal of loss had it continued beyond a few hours to the financial institutions. Fortunately for everybody, it didn't. You want the coverage to expand beyond when the network comes back up. If your network goes down and you're suffering a loss, just because the network is back up and functioning doesn't mean you replenished entirely your sales volume, for example. So you want the policy to reflect that reality as well. The policies always have a waiting period before which the coverage kicks in on this aspect of the coverage. So your network has to be down a certain number of times. 2 hours is pretty standard. You don't want hourly sublimits in there because the problem's usually front loaded at the beginning. I try to negotiate this down to 6 or 8 hours.
And that's something you again have to negotiate in every insurance, or is that something you do at the front of the coverage and it renews automatically? So
the insurance, always the most challenging bits are the first initial placement with an insurance carrier, and you want to identify, a really good starting off-the-shelf form. There are a number of them. There are a number of very poor ones as well, and then you want the insurer issuing that form to be one that negotiates, and most of them in this space do. But really, ideally, the first placement is where you negotiate your best coverage. Now, it doesn't mean that at renewals you wouldn't consider another insurer or another policy, and then you kind of have to do the negotiations over again. But insurers in this space definitely appreciate that organizations will seek to improve the substantive terms of their off-the-shelf forms, both at initial coverage placement and at subsequent renewals. So they will expect that even after you've done the initial placement in connection with the renewals, the policyholder will ask for additional good substantive coverage terms. It's expected. Most of them don't cost more money. It's just what you do in this space, like in the directors and officers liability space as well. Other kinds of insurance like commercial general liability and property, it's really not like that. There's great value in assessing those coverages for cyber, data privacy, and other kinds of risks to know what's there and to know what the gaps are so that they can be addressed. But this is really a coverage where you can negotiate and should negotiate at initial placement and at the subsequent renewals as well. Digital asset coverage, very important under these policies. The digital assets of a company can easily eclipse the value of the physical assets. Extortion. This has become a very popular subject lately with all the ransomware demands. It has been in these policies since their inception 15, 20 years ago. However, it didn't used to be ascribed much premium and wasn't really underwritten. Now it is, because the risk has materialized and thieves have figured out how to monetize this situation. So that's certainly something to look at. Reputational harm as a separate kind of business income loss is as a separate coverage is increasingly common in these policies as well. Now, DIC coverage, here's the questions. The questions really in this space are around coverage for bodily injury, third-party bodily injury, and property damage. What if, for example, a cyber event causes physical injury to the organization's property? What if a cyber event causes third-party bodily injury? It has happened already. What if a physical event, like a flood or a fire, causes a digital asset loss? These things happen all the time. The typical cyber policies exclude physical causes. And so you just want to be aware of that. This is one example. The market is addressing these issues so that there now is coverage for first-party bodily injury and property damage and business interruption. And it becomes an issue, though, if you have a very large problem, what the market capacity is for anyone insured. And what that really means is how much coverage can you get? Can you get a tower of 100 million to respond to it? 200 million. I know some companies that would love to buy over 1 million, over 100 million. It's just not. It's not available yet. But this is a drop-down difference in conditions policy offered by AIG, which drops down to pay a loss that's excluded under the underlying traditional property policies that a company would have typically to insure its own property and assets, and the commercial general liability policy that a company would typically have to insure itself against claims alleging third-party bodily injury and property damage.
So Roberta, does that mean that you should have different insurers for different policies as part of your strategy?
Well, not necessarily, but I don't also think it's there are some people that would tell you that you should have the same insurer to avoid pointing fingers. In my view, that's not the way to do it. What I would do is I would say, Chubb does a great job at directors and officers liability, right? Just by way of example, and they do. But I would not recommend Chubb based on any of their forms for cyber. AIG does a great job. Lots of the London market will manuscript you a really solid cybersecurity policy. So I think that what you need to do is you pick the best insurer and policy for every different risk. Property insurance, general liability, workers' comp. Identify the best carrier and the best policy, and then what you want to do is all of the policies will have an other insurance clause in them, which will direct you which policy responds first. Because if something happens, you're likely to have multiple different policies responding in some fashion, and you want to know based on overall limits, self-insurance features like deductibles, waiting periods, retentions. You want to know how best to maximize your coverage in a claims setting. So knowing what you have in terms of the entire insurance portfolio is important. But I really don't think it's important or not important to have the same carrier, but it is important to identify which carrier and policy are the best for each unique risk that the company is trying to address.
Thank you for that answer. I think that brings us back to the point that we need a good team, and particularly external counsel, to guide us through this melee.
It is something that I really do enjoy proactively helping companies get their arms around. It's much easier. I think, Dan, actually, you and I have talked about this. It's better to proactively know what is there rather than in the midst of a crisis trying to figure it out. And shoring things up. Traditional policies, and by traditional, I mean anything that's not a dedicated cyber product, can certainly respond to the various threats. And again, the key is just really to know what the company has. So we're looking at maybe, for example, directors and officers coverage, errors and omissions, professional liability coverage, employment practices, fiduciary duty, crime. The crime aspect of this is rather important when you consider the social engineering aspect as well. Social engineering is such a problem. It was a problem with the Target breach, but it's a big deal because cyber policies don't cover theft of money from accounts. So if you get one of these traditional vendor scams, they either won't trigger the coverage, or there'll be a specific exclusion for transfer of money. And so often we have these vendor impersonation scams, or you've got a person purporting to be the company CFO and requesting another employee transfer the funds. The trouble is that, again, cyber policies don't cover the theft of money from accounts typically, unless by crime endorsement. And crime policies don't cover social engineering. Typically, again, it's important to note the actual language of the policy, but as a general matter, they don't, and the carriers will take the position that they don't, unless there's a social engineering endorsement, which is usually very significantly substantive, something like 100 or 250,000. So insurers routinely take the position that there's no coverage for the typical vendor fraud scam under the computer fraud coverage agreement of the standard iterations of crime policies. And this, they say, is because social engineering doesn't present a sufficiently direct loss. So there are ways to address that, however, but it's just important to be mindful. You can get the endorsements to the cyber policies for crime, and that's a good way to do it.
And Roberta, does it need to be a crime in the jurisdiction where you live, or how do you manage that jurisdictional aspect of defining crime?
Sure. Well, again, you really want the policies to be broadly enough worded, and it shouldn't, a crime should be anything that causes you a loss. Crime's not actually defined in the policies. It's typically a theft of money. So basically, if you're an organization and you've been tricked into transferring money to a party that's not deserving of the money, who's not the real party that's supposed to get it, then that should suffice under the better policies to trigger the coverage. And again, the coverage under these policies that we're talking about is worldwide, but you would not have to show that the theft satisfied, that the thief, I suppose, was liable under any kind of crime statute or code. I hope that's responsive, Dan.
Absolutely, thank you.
Terrific. So here are some of the challenges. It is very important to look at the company's entire insurance program to figure out where, potential coverage for different threats facing the organization is, and to prioritize those coverages so that you know which ones you want to respond first. Now, as far as the traditional policies go, increasingly, data breach and data compromise and cybersecurity exclusions have been making their ways into the policies. This is an example of a 2014 exclusion that was introduced into standard form general liability policies. And it purports to exclude damages arising out of any access to disclosure of a person's or organization's confidential or personal information. So that's data breaches it doesn't want to cover. And then it also applies to damage caused to property. This iteration of the exclusion has an exception at the end for damages because of bodily injury. But there's another version of this exclusion that excises that. And so the implication being that if you have that version that doesn't have the exception, that bodily injury wouldn't be covered under the commercial general liability policy either. And this comes as a surprise to many risk managers who absolutely expect that if you have a data event that causes bodily injury, it would be covered. And the ISO, the organization that's charged with reviewing and approving standard form language, has said that this version of the exclusion will result in a reduction of coverage. This is an example of an exclusion in a property policy. Again, it's really pretty typical of what one finds in first-party traditional property policies, and it broadly extends to certain threats, including computer virus, which is very broadly defined, regardless of any other cause or event contributing to the loss. That's a big deal. In the United States, that kind of very broad anti-concurrent causation language is not always enforced. But again, when you have a loss, you want some reasonable level of comfort that you're going to be covered for the loss, if that's the expectation of the company, without fighting with the insurance carrier and paying counsel to go and to do that. So what does cyber insurance not cover? Intellectual property, theft of intellectual property. When you have, you're a DuPont and you've been working on developing something patent worthy for 20 years and it's been stolen, your Pepsi and your secret formula is at risk. Those kinds of things are very difficult for underwriters to insure because they're so difficult to value. And so this is the one thing, the theft of the crown jewels, that really there isn't coverage for. Just about everything else, though, there is coverage for, including the physical act of loss, the physical cause and effect of cyber, as I call it, and the bodily injury. Because that is all what has happened. So how is coverage determined, and examples for how you place a solid policy? And I think we're getting to, you identify a good one off the shelf with help from a knowledgeable broker. It's tremendously helpful, and there are people like me that are very happy to give very low fee arrangements to help you identify these things. Claims are being denied now based on procedural reasons, including late notice. And I've got a slide later on that shows a typical notification clause. Again, you want, if you've got an incident response plan, you do want the insurance policies that may respond to that, cyber insurance, crime insurance, perhaps property and general liability. You want the notification provisions, who and how to notify in that plan, so you don't want to lose coverage based on late notice. And carriers love things like late notice, lack of cooperation. It's low-hanging fruit for them to deny coverage. They don't have to work very hard. Insufficient limits is a big one too, for regulatory liability, for your dependent business income loss because the third-party system goes down, or non-malicious events. Those you want to make sure that you're aware of what the sublimits are. No retroactive date. We talked about that and how things happen far long before a company may find them, and making sure the retro date is sufficient. And substantive reasons too. There have been coverage lawsuits around, and this first one, there are exclusions in some of the policies. Happily, I've always managed to get the insurance carrier to take them out, again, for not additional premium, based on failings in cybersecurity. And again, this is negligence. This is exactly why you purchase the insurance. So those types of exclusions, which are fairly prevalent, they're in about, I'd say, 30 to 40% of the policies, should be removed. Misrepresentations and omissions in the application. This is a big deal too. Of necessity, everyone on phone call probably would want to be involved and need to be involved in the application, which I'm going to touch on the application and what underwriters are looking at in a little bit as well. But of necessity, you know, IT people must be responding to the application questions, which are fairly specific in terms of computer security and records, and where are the records of the company. And these are people that aren't versed in insurance coverage law, that wouldn't know that an innocent misrepresentation or a misstatement innocently made can void your insurance coverage from the get. Not in every jurisdiction, not in every jurisdiction even in the United States. But if your policy is governed by the law of the state of New York in the United States, it does. So it is important to be mindful of things like that. Again, insurance carriers are beginning to deny coverage in this space. It's not magic. It's like anything else. Underwriters don't make money by paying claims. They make money by collecting premium. This is my
question in regards to that. When we're dealing with incidents such as ransomware, can they claim that the human being clicking on it was negligent?
They can. That would be a horrible argument under the better extortion ransomware components of these policies. Now, what you do find, Dan, and I think that you and I talked about this the other day, is that some policies don't apply to intentional acts anyway of employees in that space. And so what does intentional mean? I've got a slide a little bit later that shows how you curtail to a smaller control group the acts, errors, and omissions of individuals that could void the coverage, either under the insurance agreement or in exclusions. And I'll definitely talk about that in a little bit. I've got the snowflake here because unlike in any other line of insurance, cyber insurance policies truly are like snowflakes. The forward-facing marketing materials of all of the 50 or so leading property and casualty insurers worldwide that sell the stuff would lead you to believe that they all sell the same basic stuff: privacy and network security liability, crisis management, regulatory coverage, business income loss. And that you're just looking in terms of what the premium is. This couldn't be farther from the truth. These policies are all different. There's no standardization. And so it does create a challenge for companies trying to figure out what is good coverage versus what is bad coverage. Almost all of the policies have their own unique sweet spot. But is it important in terms of what the company's real risk is? So, but it is, again, it's an opportunity wrapped in challenge. It really is. If you know what to ask for, the very unstandardized nature of this policy creates a unique opportunity for negotiating the coverage and getting really good coverage for less money. So let's look at a couple of the traps. That's a spider web, by the way, my one irrational fear in life. We talked about how, like the target breach, it's almost always, so often, I should say, a third party that creates a problem for the policyholder, both on the claims end, if there's a data breach, and on the business income loss end, if the cloud provider goes down, or something like this. This policy is actually, it's a pretty solid policy. It's data breach wrongful act is the term that triggers the coverage under this policy. And it's defined to mean any act or alleged act, failure to act, error, omission, misstatement, other things. It's fine. The trouble is that it has to be an act by the insured. Now, insured in this policy is not broad enough to extend to third parties, nor would you want it to be, because you don't want a third party able to access your insurance. So the solution is take that out, so that it's just a wrongful act that triggers the coverage. And this insurer will do that, and they don't charge more money for it. We've done it we've fixed that on a number of occasions. This is an even better, very clean policy off the shelf. It's issued by AIG. Privacy event in this policy triggers the coverage, and it means any failure to protect confidential information, and it goes on to include without limitation a bunch of other stuff. That's exactly the kind of very broad, simple language that you want. Confidential information, I don't have the definition here on the slide for you, but it's information in your hands or in the hands of any third party who has it on your behalf. It's a very broad You don't have to know the who, as we talked about earlier, or where the information is. All you need is a claim that alleges something happened to data and it's your fault. And that's exactly the kind of thing that you want. That's what we want. So speaking of the employee situation, this is a Heinemann study. It's a little bit dated, but I believe the findings remain accurate today. The most common cause of data breach is a malicious insider. So you've got disgruntled employees, right? So here's an example of a conduct exclusion. Conduct exclusions are contained in some iteration in every cybersecurity insurance policy. And so the key is to have them narrowly curtailed as much as possible so that they don't swallow up the coverage that the company is trying to get. So this applies to void coverage purportedly based on any dishonest, fraudulent, criminal, or malicious act committed by an insured. Again, insured is too broad. It pertains to any employee of the company. So what we do, and insurers, again, they routinely grant this request for no additional premium, and now you don't have a problem. You limit that to a small control group, CFOs, CIO, small group of upper-level people whose conduct can void the policy. And then you also want severability of exclusions and those kinds of things. Best practices, a team approach. IT professionals, inside legal counsel, broker, compliance, privacy professionals, outside counsel, the best way to get you the best coverage. Understanding the risk profile so that it can be addressed. Reviewing existing coverages so that you know what is there and you can maximize coverage across the entire insurance program when there's something, when something goes awry. Remembering the cyber misnomer, we really are talking about data and privacy in whatever form, although granted for most of us, that's largely a cyber issue. Spotlighting the cloud, remember the retro date, remember that things happen long before they're discovered, and so it's very important the insurance reflect that risk. Selecting counsel and vendors. If you like to work with Mandiant as your outside forensics, make sure to request that while you have leverage in the underwriting and get them pre-approved so that you can use that outfit or whoever you like without the insurer's pushback when something happens. Carefully review the application. Beware the fine print. The devil really is in detail. And in the application and underwriting, the kinds of questions that you'll be asked are, what kind of data do you have? What kind of protected data? Health data, credit cards, social security number, whatever it is. Where is it? Do you share it with third parties? How long is it kept? If your network is on the third party side, if your network's disrupted, what do you think your likely loss would be? The first applications can be a little onerous. I don't find my clients having too much difficulty with them. It is important to get the application right. I've also never had a client denied coverage. And often going through the underwriting application itself can shine a light on potential shortcomings in data privacy policies and cyber security, network security that can and should be addressed, and companies do that, and that's helpful even if you don't end up actually purchasing the coverage. So different things that you can choose. Yeah.
We have a question from Peter asking, is there a standard coverage for cybersecurity insurance that applies to all? Is there a base coverage that everyone should have?
So I think it really behooves companies. So most of the policies are sold sometimes in a modular network so that you can pick and choose among the 6 or so standard coverages. I think it really behooves all companies to at least consider whether they should have the privacy insurance, which comes with the crisis management coverage. Realistically, you're not going to have one and not the other. Although for smaller businesses, you can get you can buy policies that do just provide crisis management. and then some provide, that's the data breach coverage, the things you have to do in the wake of a breach. So notification to potentially impacted parties, engaging with public relations firms to help the firm's brand and reputation, the call center services, the credit monitoring that's required for a year in most United States jurisdictions, for example. I think it's very worthwhile to consider that cover. I think it's very worthwhile to consider the base standard cyber policies, which would include both that, so that's the data breach coverage and the crisis management coverage and forensics that comes with it, and also the business income loss coverage, because really any company that's doing business online, which is any company, or relies on a computer network, which is really any company, I think these days, is liable, is facing some threat. Now, if it's a relatively low threat, the insurance premium should reflect that, so that it should not be expensive to cover it. So I really think that every company should be, considering the base. And I can certainly send materials if the person asking the question would like to send me an email. I can shoot you, the typical standard cyber, suite that's offered by the 50 carriers that operate in this space. And I think every company should be at least considering it, especially given the proliferation of exclusions in the other insurance policies that the company is likely to have around data protection and privacy.
And before we move on to the event of a claim, you mentioned that going through the process of underwriting often gives you an insight into potential issues. Does proving you are more mature or proving you're more advanced lower your premiums?
So this is not something that I have found. I can't say. Proving that you're addressing a situation, just by way of example, I was assisting a Fortune 50 company with placing their initial cyber insurance. They were not PCI DSS compliant, which is a big deal over here because payment card industry data security standards are, they carry with them some pretty significant fines and penalties and sources of liability. They weren't PCI DSS compliant, but on parallel tracks, they had discussions with the underwriters. It was AIG at the primary level in that case. And they said, look, we know we're not there, but here's what we're doing. And they got full PCI DSS coverage. So it doesn't, I have not seen it. I mean, theoretically, of course, it could lower premiums. That's not something that I've actually seen, but I have seen underwriters react well to companies that are proactively addressing potential shortcomings in security and the data privacy protection by offering the substantive coverage. So I think it's probably important to the company to mitigate liability. It will help to get the insurance, should help to get the insurance. I don't know that you should probably not go into a placement or renewal assuming that you're going to see a reduction in premium, however, on that basis. In the event of a claim, again, don't lose coverage because you failed to follow a procedural issue. If something happens, insurance companies, every single insurance policy will have a notification provision to the carrier, and they often read something like this: you have to give notice as soon as practicable after something. A member of the control group, again, this is a good policy relatively because it's not just the notice provision isn't triggered by just anybody discovers something. It has to be, it has to have gone up to a level that someone would think, okay, we better notify our insurance carrier. But notice provisions are important. Cooperation provisions, again, policies have cooperation provisions. It doesn't mean that, especially if you think, if an insurer hasn't accepted a claim, if they've issued a reservation of rights to deny coverage, this is very common and not necessarily troubling. You don't necessarily want to hand over everything, but you want to at least give the appearance of cooperating reasonably. And a lot of times, from my perspective, I've seen a lot of problems over the years because I've been contacted when an insurer denies coverage, so I do see problems. But a lot of times, liaising with the insurance carrier can be helpful. It's in their interest to mitigate loss as well. So it can be a fine line depending on what the dynamic is in a specific circumstance, but it is a policy condition to be aware of. And then if there's more questions, Dan, I'd love to answer them. And again, of course, if anybody wishes to reach out to me, I'm happy to answer any follow-up questions as well.
We have a question from Russell. I say, much like ISO practices or standard insurance, it ran away from me, or standard insurance audit reports of best practices to limit potential events, is there a standard for cybersecurity today? Do we know that the insurance companies are using a specific audit or approach or report?
So they are tending to underwrite to the NIST framework more and more. Is something that I've noticed. The National Institute of Standards and Technologies issued its cybersecurity framework, which includes, by way of vast appendices, I think, the ISO standards as well. NIST is, I mean, it's a U.S. kind of construct, but insurers worldwide are underwriting to NIST, and NIST certainly incorporates ISO standards. And so I think the answer to that is, is yes. I think that it's probably, the NIST framework is helpful. I mean, even within the United States, NIST only applies to certain critical infrastructure organizations. And yet most organizations take note of NIST outside of its province, right, as a way to determine their state of cybersecurity and move to an elevated state. And insurance carriers worldwide likewise are underwriting to NIST standards, which incorporate, again, ISO.
Excellent. A question from Steve. He sees a growing interest in the consumer IoT arena as it relates to assessing and signaling security and privacy of devices. Do you see a trend towards underwriters requiring this to write certain types of coverage? So, for example, televisions, thermostats, those type of IoT devices.
Right. The Internet of Things presents a very significant concern to underwriters. They don't have the benchmarking and actuarial data in place. I think we will see more of that. Underwriters they're still getting their arms around, what does the IoT mean in terms of bodily injury to people? What is going to happen with these things? I'd be happy to liaise with a broker friend of mine. We're due to talk later this week anyway and get back more fulsomely on that point as far as what the underwriters are where the current thinking is.
Excellent. Well, I want to respect everyone's time. Those are the questions that we have so far. Roberta, this has been very insightful, at least to me, and I think to the audience. Oscar, do you have any closing words for us?
Dan, actually, I just want to thank Roberta for sharing this information with us, and to you, Dan, for moderating the webinar. So that's what I got.
Thank you very much for attending.
Thank you, Dan. Thanks to all the attendees. Really appreciate the opportunity.
The webinar was recorded in case anyone missed parts of it. So we'll share the link with you guys to make sure that you have the webinar, and feel free to share it with your friends. Thanks, everyone.
Thank you.
Thank you, everybody. Bye-bye.
Okay, bye-bye.